sensitive. After an initial boost up in levels after accession of various Eastern European states, we had it quite sensitive to relative movements in the economy of the Eurozone and the UK. So when the UK economy was doing worse than the Eurozone in 2008, 2009, net immigration fell considerably, and then once they started to go badly with the Eurozone crisis blowing up, then net immigration burst up again. The way I think things will probably work is, as the Eurozone economy improves, which I expect it to do, partly because we're leaving, in fact, but just because it starts from such a low base as well, I think that the pressures on people to move in order to find jobs elsewhere in the EU will fall. So that will allow the government, with relatively limited additional controls on immigration, to take a political dividend. So what will tend to happen is that immigration from the EU would have fallen even if we'd remained. The government will introduce some limited controls on additional immigration from the European Union, and they will say, look how wonderfully it's all working, when immigration falls as it would have done anyway. And so I don't expect that you will have that much net impact on immigration over the medium term. It might be that it'll fall for 2 or 3 years to something closer to 100,000, just so they can show that they can do it. But over the medium term, I don't think there's actually much appetite in the UK to materially restrict immigration from France or Spain or Italy or Germany. I mean, we've had almost free movement with these countries for 3,000 years. We're not going to stop now.
Andrew, all the focus on Brexit, are we focusing on the wrong thing?
These numbers, so was it between the autumn statement 2015 and the March 2016 budget, I think that the 2018 GDP level was estimated down by 1%. So if we were talking about what was going to happen by 2030, if I'm right that we're talking about numbers of the order of a couple of percent either way, I think that that's relatively small beer compared with some of the other kinds of factors that would move things around. If we were to haulix up the process of normalizing interest rates, for example, if we were to either wait too long and end up with inflation going high, or act too early and end up destabilizing, creating a new financial crisis, that could totally dwarf any of these other kinds of impacts in terms of the consequences for the economy. And that situation, and I think that's something which we've kept expecting to be a thing. I've kept expecting us to be in a situation where we start normalizing interest rates for some years. It must happen in the end, and when that comes, which may well be over the next few years now, that is likely to be a more important thing than some of these other matters. Also, other kinds of questions. Well, if we were to elect Jeremy Corbyn in 2020, then you might well think that the impact of Brexit was relatively small economic beer compared with the negative consequences of that mercifully unlikely scenario. We suggested that the car sector was one of the sectors of the economy which had gained the most out of the single market. So you might have found that absent single market membership, cars might have been an additional 40% more expensive in the UK by today. At some of the lower end estimates, it might have been much more than that. So the importance of the car sector is quite significant within the single market. It's also the case that the car sector is one of the UK's manufacturing economy goods news stories of the past few years, much more so than I think many people appreciate. Nonetheless, you have this issue. So what will happen with the car sector? It tends internationally to be one of the manufacturing sectors that's subject to more tariffs. So something like 10% is a standard order of tariffs. For example, US cars coming to the EU pay 10%. You have around 25%, including non-tariff barriers. So I use the car sector in some of my estimates as the outer envelope of how bad things could go in terms of if we were ending up in a WTO type situation. The Germans, I think of the single market as a very important creation, and they very much value the 4 freedoms. So they see them as a completely one indivisible whole, free movement of goods, services, capital, and labour, and they wouldn't like to see anything threaten that. There is a sense in which, though, a single market at that level isn't quite the same thing as trade. Trading, by its nature, involves some difference. So we do things differently from you, and there's some comparative advantage from the 2 ways of doing things. We do things our way, we sell to you. You do things your way, you sell to us. And I think that there is a difference in the British perception about that. We don't want single market membership. It's not that we think the single market is just trade. We don't want single market membership. We want to have a trade deal, like the trade deal that Canadians and others have with the European Union. And I think that that gap in perception of exactly what we want is an important one, and that we need to be clear. What we're after is just a trade deal.
Inflation going up, wage growth not increasing at the same rate. You know, Vince has touched upon this. Surely that will have an effect on British consumers and how much they can spend.
I would expect it would. Of course, inflation coming back closer to target would normally be considered to be a good thing, right? I mean, inflation's been far away from target for some years, and now we're going to have inflation probably in the 2 to 3% range. It might be that it would go higher. If it did start to go above 3%, I think the Bank of England should be increasing interest rates to prevent it from going up. That also, of course, is one of the factors with sterling. Insofar as inflation is driven by sterling weakness, you'd expect sterling to strengthen if you raise the interest rate. So it seems to me to be entirely within the Bank of England's gift to prevent us from having excessive inflation just at the moment. One important and underreported thing that's happened over the past year is a very considerable increase in monetary growth. So from the period of 2007 into 2008 and after the financial crisis, with the banks doing very badly, you had very weak growth in the money stock. That was part of the reason we had quantitative easing and various other sorts of measures to try to get monetary growth up. I think that historians will say that Q3 2016 was when the monetary aspect of the Great Recession came to an end. Now, that might be coincidence. I think it probably is. But I think that the normalization in the money growth and consequently implications for inflation going back from being a period of deflation earlier across Europe to things closer to 2% over the medium term, and probably interest rate rises will be one of the key economic features of the next few years.